Welcome, everyone. My name is Nikki Johnston, and I'm with Transition Advisors. Our webinar today is Preparing Your Firm to Grow Through M&A. Before we begin, we need to cover just a few important items. First, please close any other programs that you have running on your computer. This will just help to ensure quality presentation and reduce any audio issues that may come up. Transition Advisors, LLC is a proud and approved sponsor on the National Registry of CPA Sponsors, per NASBA. Under the new NASBA guidelines, today's 60-minute session will qualify for 1.2 CPE credits. In order to receive those credits, you must complete two requirements. The first is that you participate in all 4 of the polling questions throughout the presentation. And please note that GoToWebinar does monitor your participation in those polls. We will give partial credit for those who answer 3 of the 4 polls. Next, you must complete an online evaluation that will appear on your screen immediately after the end of the webinar. So please don't close your browser before you've had a chance to complete that survey. Once you've met both of those requirements, I will email your CPE certificate within 10 business days. Now, in order to fully participate in the webinar, please take just a moment to familiarize yourself with the GoToWebinar control panel. It should be on the right-hand side of your screen. There's an orange arrow near the top. You can use that to minimize if you'd like. Participants are muted, but you can communicate with us by using that question box at the bottom of the panel. And we will answer all of your questions at the end of the session. And if for some reason there are more than time allows for, then we will address those by email afterwards. Finally, I'd just like to remind you that Transition Advisors offers 2 free 1-hour CPE webinars each month. The upcoming topics you can see there on the screen. They include admitting new partners, succession planning and valuing your firm. That one is actually a 2 CPE class. Preparing your firm for an upstream merger. And if we have anyone on the call today that's in Florida or Georgia, we have a webinar specific to the southeastern United States in November. You can view a complete list of our webinars and register for those on our website in the CPE courses section. Finally, I just want to remind you that in the reminder emails that you received from GoToWebinar, there was a link to download a PDF of the presentation. I'll also send that same link through the chat function. If for some reason you would like to receive that as an email attachment, you can just send me an email. My email address is on the screen now, or you can reach me by replying to one of those GoToWebinar reminder emails, and I'd be happy to send you the PDF as an attachment. Now I'd like to introduce our presenter for today's session. Terry Putney is the CEO of Transition Advisors. Thanks so much, and I hope you enjoy the webinar.
Thanks, Nikki. You know, it takes accountants to come up with 1.2 CPE credits, so only we could do that. Transition Advisors is a national consulting firm that works strictly with issues associated with the transition of ownership in CPA firms. Our services fall into 3 primary categories. We work on mergers and acquisitions. That's the deal facilitation part of this. And in that category, we perform searches looking for buyers and sellers on behalf of clients, put together introductions of those parties and help with the negotiations. We also provide transaction support not only for those kind of deals, but other deals that our clients find on their own. We're not exclusively working with firms that we've made the introductions on. So if you find your own firm, your own party to do a deal with on either going up or down, you need assistance with that, we do provide that kind of service. And then finally, we also work in the area of practice management with succession planning and structure and modifying owner agreements. So we're going to talk about today primarily M&A, not our services, but the issue of M&A. What we're going to go over today is developing a business plan for your strategy to grow through merger and acquisition. Assessing the market that you're operating in and how your firm is positioned to compete in that market for acquisitions. Selling your opportunity to potential candidates. The process that the deal should go through, how to actually manage that. Specifically what kind of issues you're going to run into in terms of structuring deals, and then the 4 C's, which addresses culture issues with respect to a firm that you're acquiring. We're going to start off with a polling question. I'll turn it back over to Nikki so we get an idea of who's in our audience today. Thanks.
Okay. The first polling question is on your screen now. How many equity partners do you have in your firm? I'll give everyone just a few seconds to answer this first one. And again, there will be 4 polls today, and NASBA requires to get that 1.2 credit. Do you answer all 4? If you answer 3, then we'll be able to issue 1 CPE credit. I'll go ahead and close the poll, share the results there. 44% are sole proprietors, 38% in that 2 to 4 range, and then the remaining folks on the call are 5 to 9 equity partners.
Okay. So the sole looking for a way to strengthen your succession team for your own succession down the road through M&A, or you're looking for a possibility of merging upstream and kind of want to know, what that looks like from the other point of view. So going forward, the business plan. We find too many firms go into this process without a clear understanding of what they're trying to accomplish. The result can be that they're talking to the wrong firms, basically. And unfortunately, sometimes you find that out when you're already in the middle of a deal and all of a sudden you realize this isn't working, or this isn't a firm I really want to do a deal with because there's an issue here that we really should have known going in, and we should have never started this conversation had we thought about that. Or in the worst case scenario, you actually find out after the deal's done. So generally what you need to do first, of course, is define what it is you're trying to accomplish. What are your strategic goals? Why are you, what specific kind of growth are you trying to accomplish through a merger and acquisition? Many firms go into this just with the idea that I just need to get bigger for whatever reason. It could be because you want to position yourself better in the market in terms of competition, that a bigger firm would be a better position for the kind of clients you're going after. It could be that you're looking for, increased profitability for yourself and your partners. That if we're managing $500,000 a piece in business, if we were managing $800,000 or $1,000 to $1 million, we probably would make more money, and that's what we're trying to do. It could be you're trying to build a long-term asset for yourself that you eventually intend to sell. But in terms of general revenue and client growth, that's a legitimate category or a legitimate goal to have. The other issue is, of course, partner level growth, trying to build the firm bigger, because a bigger firm is stronger, has a better chance of being viable down the road. For those of you that are sole proprietors, obviously you're going to have somebody if you want to keep your firm alive through your succession, somebody's going to have to take your place. So a bigger firm creates more capacity for more partners. It could be that you're looking to expand into new geographic markets. That's certainly the issue with respect to the top 50 firms in the country right now. Most of those are what would be considered semi-national firms. And if you're operating primarily in the southeast United States, for instance, and you want to be considered more of a national player, there's certain markets that you need to be in order to be considered that. It could be that you've just got a map that's got holes in it that you want to fill. Certainly one area is to try to acquire new service lines, looking for firms that provide specialty services that you don't provide that fit well with your current client base. For instance, wealth management services, business valuation, certain kinds of consulting for manufacturing or other types of industries and so forth. Or if you have clients that you're looking for more clients to cross-sell into your specialty areas. So we offer a really strong consulting and manufacturing. Let's try to acquire a firm that has some good manufacturing clients so we can cross-sell those services to. And then, of course, a talent search. Looking for firms that have talent to either at the partner level or below that will increase the level of talent that you have in your firm. That's generally one of the categories that most firms are looking for. I'll tell you, it's the hardest one to fill because firms that have strong talent generally are not looking for an upstream merger, but that's not always the case. So it can be accomplished. It's just a more difficult one to do. Next issue to consider is whether you really should be dealing with a merger or a purchase. So what is the difference between a merger and a purchase? Well, I'll tell you first, always call whatever you do a merger when you announce it. I don't care if you bought a book of business out of an estate of a practitioner that's died, call it a merger. Clients don't like to be sold. And so when you say I acquired a practice, I bought a practice, or when the seller says I sold my practice, you're basically telling the clients they were sold, which is not something that most clients perceive as, basically it's, don't I have a choice in this? But anyway, getting back to the specifics of what the difference is, it generally comes down to what the equity status is of the acquired owners after the deal. So if you acquire a firm that has two partners that own the firm, and those partners become partners and owners in your firm, that's a merger. On the other hand, even though they may stay working with you for a long period of time, if they don't become equity owners in the firm, that's an acquisition. So it's important to understand, because at that point, everything changes. Generally, the rule of thumb is that when you're looking at a firm to acquire in the firm to stay 5 or more years, generally you should consider whether or not they would qualify and whether or not you would want to make them equity partners in your firm. If you're looking at partners that are going to be there for less than 5 years, generally it's not worth the trouble, and it creates issues by bringing them in as equity partners, and instead you should be looking at it as more of an acquisition. Now, there's a technique to doing this when you're dealing with somebody who's going to be with you for, say, 3 to 4 years. There's a way to do this that creates many of the benefits of a merger with still keeping it as an acquisition. We call that a two-stage deal. We're going to talk about that later in the presentation. But generally, that's kind of one of the most important issues, is how long are the partners going to stay with you after the affiliation starts. Many deals are combo deals, meaning we've got, if we're talking about a 5-partner firm, it's generally the case that you're going to have 1 or 2 of those partners that probably should be treated as an acquisition. Their portion of the deal should be treated as an acquisition, whereas the other 3 or 4 maybe should come in as equity partners. So remember, when you do a merger, new partners and you're assimilating them into your firm, they bring what they own with the firm. However, when you do a purchase, you're not buying partners, you're renting those partners, and you're renting them for the purpose of executing your business plan. They're bringing and you're buying what they own. So the difference is really the role in the relationship, the contractual relationship that you have with the partners after the acquisition. It becomes awkward to have non-equity partners if you're buying a firm and they're going to be around. Their plan is to be around for longer than 5 years. It can be kind of awkward to have those people there in that role for longer than 5 years as non-equity partners. Now, if it's somebody who naturally fills that role, somebody who already was a non-equity partner, or who's someone who doesn't really have the capability of functioning as an equity partner in your firm, that's different. What I mean is somebody who's really in the process of trying to create succession for themselves. If they're going to be around for longer than 5 years in a non-owner relationship, it can be awkward. So when we talk about planning, it's important to identify and properly understand the resources that are going to be necessary that you're going to have to use in the acquisition. It's very difficult in a purchase acquisition to avoid an investment in the first year. I've worked with a lot of firms who, come into it basically undercapitalized or feeling like I really don't want to spend any money on this deal. I'm going to try to do it without coming out of pocket. And it's almost impossible to do to create a realistic set of terms with respect to an acquisition, a purchase, without coming out of pocket. It's hard to do in a merger as well, but it's a little bit easier because we're not actually having to deal with the transfer of assets. We're really kind of exchanging assets or access for equity. But even in those situations, it's going to be difficult to do it without some investment. Generally, the biggest issue that people kind of tend to forget about is the working capital. Most firms operate with somewhere between 20 and 25%, as high as 30% and even higher of their volume is invested in accounts receivable and work in process. Generally, when you do an acquisition, if you do a merger, you can get the selling firm partners to contribute those assets to your firm as a part of the capital contribution. There's some tax issues associated with that, but generally that's the plan. In an acquisition, normally the seller has an expectation that they're going to retain those assets as part of the values. So it's not, the typical deal is structured as, I'm going to pay you for your book of business over time, but I'm going to let you keep your receivables and WIP. Today, one of the trends that we're seeing is that buyers are asking sellers to let them use those assets for a period of time, maybe up to 2 years, to try to help with the cash flow. But generally, there's going to be a working capital investment that needs to be made early on in the deal, and that oftentimes is overlooked. Technology upgrades, trying to get their technology on your platform is going to usually require an investment. Sometimes an expansion of facilities is required. If you're using their facilities, of course, you can just keep going, but if you're moving them into your facilities, oftentimes there's a need for some leasehold improvements, maybe even expansion of the footprint. Training is a soft cost that oftentimes gets overlooked, but keep in mind also that all of these costs can be offset with synergistic cost savings. So my rule of thumb is that when you combine two offices, once you get past the initial investment required to do that, you should be able to pick up somewhere between 10 and 20% of the volume of the firm you're acquiring in terms of cost savings, because you can eliminate some administrative personnel typically. You certainly can eliminate much of the facilities cost. If you're not combining facilities, generally you should be able to find somewhere between 5 and 10% of the volume of the firm you're acquiring in synergistic cost savings. And it can be much higher. When you have excess capacity in certain areas, then you can find much greater savings. The problem with going in with an unrealistic expectation on the investment required is if you try to push the investment required back into the deal terms, you end up sometimes with unrealistic deal terms. So I've actually had buyers try to get sellers to pay for the investment that they're going to make in the investment, and needless to say, most sellers are unwilling to do that. Next issue is making sure that you get your partners aligned around the plan. A problem we run into often, not all the time, but sometimes, is partner groups that have not gotten themselves on the same page. So the managing partner ends up negotiating a deal that, when he brings it back to his group, doesn't get approved because they haven't talked about some of the issues they're going to need to address in any kind of deal they might run into. Some of those obstacles, of course, are the required investment. We just went through that in the last slide. Another issue is partner compensation, what you might run into. So an example of this would be, let's say you've got a firm that's generating on average around $250,000 of income per partner, which is somewhat low depending on the size of your firm, or could be considered low. And you're talking to a firm whose average partner compensation is $400,000. That could be a really good firm to acquire, but needless to say, there could be a problem in the mix between what your partners are making and what their partners are making. Should you not do the deal because of that? I've seen many firms walk away from deals because they're unwilling to pay the partners in the acquired firm at the level that they're currently making, and it's not realistic to expect that firm to take a cut and pay to come down to your level. So it's one of the issues that you need to address is what's your sensitivity to the range of different kinds of partner comp you might run into with the firms you're talking to. Equity, defining how important equity is in your agreement. Many firms, will make a big deal out of how much equity we're going to grant to the firm that we're acquiring, but when you get into their owner agreement, you find equity has nothing to do with anything. They don't use it for compensation. They don't use it for the buyout because it's compensation-based or some other basis. And so we're making a big deal out of nothing. So I'm talking about equity and what the sensitivities are going to be with respect to how much equity we're willing to grant to an acquired firm. Looking at client mix, keep in mind that every firm has clients that are not ideal. And if you're going to acquire a smaller firm, which you're almost always going to do in a merger, where you're the acquirer, you're going to find clients that are not ideal. On the other hand, those are an asset to that firm that you're acquiring. So understanding that, what are we going to do with some of the 1040s that maybe aren't priced where we might price them. What are we going to do with some of the smaller business clients? And can we stomach dealing with those for a period of time as they sort of work themselves out of the system? As we're going to talk about later, most sellers are not very keen on walking away from a big portion of their practice because it doesn't fit into your practice. Demerger clauses come up very often. That's basically a sort of a fail-safe. What happens if we made a mistake? What if we didn't do a good job of picking our partner? The problem with demerger clauses, and I'd say probably in about 1 in 5 deals we're involved in, there might be a demerger clause involved. The problem is it can be a self-fulfilling prophecy. So generally a demerger clause is going to be time-bound, meaning that for a period of time, 1 or 2 years normally, either party can unwind the deal and walk away with what they started with. Well, the problem is that sort of hangs over the deal for that period of time because we want to make sure we protect what we may have to walk away with. And even if we're satisfied, we can't be certain the other party's satisfied. So as these due dates come up on this demerger, we have to ask ourselves, do we really want to stay here? And even worse, it keeps us from actually integrating the practice. So we're big believers. I mean, our firm is a big believer that the demerger clauses are actually not something you should try to do. You should just do a good job of due diligence, keeping in mind that if a deal is actually that bad, you'll figure it out. But to put the demerger clause into the agreement can be problematic for actually making the deal work. And then also making sure when you consider that you're acquiring talent versus buying a business. If somebody walked into your office, young stud, book a business, but was somebody that you considered partner level material, you would probably bend over backwards to try to make something work. It makes, in some cases, a fairly significant investment in a significant salary with no immediate return on that because they don't have any business they brought with them. But on the other hand, if that same person is in a firm that you're acquiring, you're not willing to make the same investment. So oftentimes when you look at what you're really trying to accomplish, when you have somebody who's has long-term potential, it can make the deal you negotiate with that person different than it would be if you were talking to somebody who was only going to be around for a year or two and was on their way towards retirement. One of the questions we get regularly now is it a buyer or seller's market? And I'll tell you that it's both. It depends on your geographic location, depends on the size of the firm and the nature of the firm. So if you're in a small market, small rural market, and you have a somewhat small firm, it really doesn't matter how big the firm is. The issue is how many firms are relevant to potentially merge with that firm. If because of the location there aren't very many, it's always been a buyer's market. So basically it's a supply and demand issue. You don't have a great supply of buyers for that firm, therefore you're not going to get the same kind of terms that you're going to get in a market where there are a lot of potential buyers. The size of the firm is also an issue, even in larger markets. So firms that run between about $500,000 and maybe $1.5 million in size are always going to be coveted for acquisitions. And the reason why is because those can oftentimes be merged into the acquiring firm with little to no increase in overhead. It's an immediate synergistic acquisition. You pick up a lot of clients immediately. They're simple and easy to do. Oftentimes you're only dealing with one owner. And so there's a lot of buyers interested in that kind of firm, and as a result, it tends to be a seller's type market for that size firm. On the other hand, if you're looking at firms that are in the $5 to $10 to $15, $20 million range, the number of firms that are relevant to those firms as a potential acquirer is shrinking all the time. And in fact, because of the major amount of activity that's been done by the top 100 firms in the country, they've started filling in their maps with those types of firms. And if you're now, a firm that's competing against 4 or 5 of those semi-national firms in your market, you're going to find that it may be difficult for you to find another suitor for your firm, and you become a tuck-in, but a tuck-in generally is going to be not as aggressively pursued as one that's opening up a new market. So the size of the firm makes a big issue, and then specialty firms on the surface oftentimes appear to have a high value because of the nature of the practice, but because of the fact that it is a specialty and there may be only a few firms that are relevant to that firm, again, it gets back to a supply and demand issue. So are very difficult to find buyers for, and as a result, that becomes a buyer's market type firm. Keep in mind, seller motivation is almost always dominated by succession needs. I don't care how big the firm is. I'd say 90% to 95% of the deals we see underlying there's a succession issue. So as you go in looking for acquisitions, keep in mind that you're basically there to solve somebody else's succession problem, and you want to make sure you're approaching it from that standpoint. In terms of competition, what we're finding is that it seems to be all or nothing. I have several clients, very large firms that are national firms, that have told us, we have so many deals to look at right now, don't bring me anything till next May. That's how active the market is. On the other hand, we're seeing firms that once they get their eyes or sights set on a firm that they really want, are willing to do deals with deal terms that we would have found unusual just a few years ago. So for instance, making large down payments, being aggressive with other types of terms because they really want the deal. So it seems to be, it's kind of one extreme or the other. If you're obviously competing against a firm that is aggressively pursuing an acquisition that you really want, hopefully you know that and you take that into account in the terms you're willing to offer. With that in mind, let's talk about valuations for a second. The trend is, I would say, generally multiples are down, whereas it was routine 5, 6, 7 years ago to see in certain markets multiples of 1.25 to 1.5. It's difficult now to see. We don't see that happening very often anymore. And in fact, we're seeing deals under 1x on a somewhat regular basis. Again, it depends on the size of the firm. We don't see 1x, something under 1x oftentimes being offered to firms that are under $1 million, but for firms that are over that, we are seeing some offers being made below 1x. We are seeing less money up front on cash down, except for the exception I just talked about earlier. We're seeing more deals, quite frankly, moving towards asset deals because part of that is, as opposed to consulting, currently deductible deals, part of the reason for that is that the payment terms are being extended. So it's not unusual now to see payment terms of anywhere from 7 to 10 years, or fewer years in 5, 6, 7 years ago. And when you get to a longer payment term, you can stomach the difference between the amortization on an asset deal versus the current deduction. So that's part of what's happening there. So if I'm going to do a 10-year deal and I'm going to amortize the payments over 15 years, that's not so much of a problem as it would be if I'm trying to make those payments over 5 years. We're also seeing payment terms being extended in order to maintain a higher multiple. So for instance, if I really need to, for cash flow purposes, to keep the payments down, I can still pay 1x if I do it over 7 years, as opposed to trying to do it for a lower multiple with a shorter period of time. Keep in mind that there's 5 components of deal terms in every deal that affect the value. Those are the down payment, or the amount of money that's invested up front, how long the payments are going to be paid over. Most deals don't carry interest on the deferred payments. There are some that do, but it's oftentimes not the case. How long the retention period and what kind of retention is going to be applied to the payments to determine the price. How profitable the deal is in the hands of the buyer. And then the result of those 4 basic deal terms is the multiple. So when you have a large down payment, when you have a shorter payout period for a firm that maybe isn't as profitable because of the tax treatment of the payments, you should expect a lower multiple. You can get justify a higher multiple, obviously, by manipulating those other terms the other way. So that's generally the way to look at the valuations. What are sellers looking for? One of the things that sellers absolutely fear is uncertainty in the deal. Because keep in mind that most sellers are used to being the total control of their practice, and they're turning that control over to you as the buyer. So that's the reason to use formulas and guarantees in the deal. So for instance, with respect to compensation, rather than, your compensation system may be completely it's discretionary, but we kind of know how it works. We kind of know what to expect because we've been here for 10 or 20 years. The seller hasn't been there for 10 or 20 years, and so giving them a clear cause and effect in terms of, if I do this, I'll get paid that, is a way to overcome that kind of uncertainty. Most sellers are not willing, unless they're desperate to do a deal, to back away from their income. Why would I keep doing what I'm doing, working as hard as I am, maybe even harder, and make less money? And that's the reason for that oftentimes deals in mergers have 2-year guarantees on compensation. Immediate sales versus slower transition. Most sellers, and quite frankly buyers, think of a deal as, like selling a house. I sell my house, I turn over the keys, I go somewhere else. It doesn't allow for a proper transition of the client relationship. It's the impact on the course of the value and the success of the deal. So finding a way to do a deal that creates a strong, powerful transition at the same time that you accomplish the goals of an acquisition or a sale is important, and that gets back to the 2-stage deal that we're going to talk about in just a little bit. Sellers absolutely fear cherry picking. As I said before, every practice has clients you'd rather not have. It's important to avoid sending, unintended messages that part of that practice is unacceptable to you, because the seller is always going to be looking for signs that you're going to be cherry picking the practice, and that's something that most sellers are unwilling to accommodate. If you actually find a practice that has a portion of their practice you're uninterested in or is a real problem for you, just be upfront about it. Sometimes we'll find practices that have too many low-end 1040s. So they're doing, 500 1040s at $300 a piece. Nobody wants that stuff. 500 1040s at $300 a piece is $150,000. Well, if it's part of a $1.5 million practice, that's only 10%. Probably deal with that in a way that may or may not retain those clients without diminishing the value of the practice that much. As long as we're upfront about it with the client, with the seller, we have a plan for what to do with that. There's a decent chance they'll go along with it. But if we are just sending these mixed messages that, well, some of your clients we really don't want, they don't know that you're really talking about only that portion of the practice. So be aware of not sending that kind of message. Why do so many sellers want a big down payment? Well, they perceive that it is a means of avoiding risk. The more money I get up front, the less risk I have. The reality is that it probably doesn't change at all the overall risk of the deal for them, because unless they're going to get all the money up front, which almost no buyer would ever do, they're really not changing how much money in the end they're going to get, but they're creating a big problem for you in terms of cash flow, either causing you to have to go borrow money from the bank or trying to accept really poor cash flow for too long in the deal, to the point where something else is going to have to give in order for you to do that. So keeping in mind that when a seller is asking for a big down payment, if you can understand why they're doing it and helping them overcome their fear of the risk of the deal in some other way, can overcome that problem. What are mergees as opposed to sellers looking for? Well, generally a merger candidate wants to see some upside. If I'm going to be with you for the next 5 to 10 years, how's that going to improve my career, my financial aspects? So if you can be pretty specific about, this is what, not that you're going to guarantee anything, but that this is what we're looking for in terms of upside for you. This is going to what's going to make our deal better than your current situation. That's what they want to hear. They don't want to come out of pocket. Asking them to write a check to give you their practice is generally a hard thing to do. Looking for some income certainty, and again, that gets back to that guarantee. And generally, what we see is 2-year guarantees. Now, why do we have a 2-year guarantee? We're not guaranteeing. We shouldn't be guaranteeing them from economic problems. In other words, if they lose clients, if they quit working as hard as they have, the guarantee shouldn't protect them from that. What it really is protecting them from is the vagaries of your compensation system. So, the fact that your compensation system may cause them to make less money, they don't know that. Basically saying is, look, if you keep your practice intact and keep working as hard as you are, we'll make sure that you make at least what you're making now, hopefully more. And that's all the guarantee should be. So it's really a limited guarantee. Sellers, of course, fear loss of control, and they fear, enhanced accountability to your firm. So just keep that in mind as you describe the culture of how you run your firm. I'm going to turn it back to Nikki now for another polling question.
Okay, thanks, Terry. The second polling question is on the screen. This is about your current level of interest in M&A. The options here are experienced, you're currently looking, you have no experience but you are actively looking, you're not sure, you're intrigued, or you're just not sure. And Terry, while they finish that poll, do you mind taking a quick question
Sure.
about what do you mean by retention period?
Okay, the retention period is the period of time that the deal is subject to adjustment for client retention. So, for instance, everybody's heard of 20% a year for 5 years. That's a 5-year retention deal. In other words, for 5 years, the deal is subject to adjustment for retention of clients. You could have a limited retention period of, we generally don't recommend less than 2 years, where we lock the price in based on the volume that we retain over the first 2 years. Or you can have a deal that goes beyond 5 years. That's somewhat unusual. It does happen. So retention period is the period during which the deal is subject to, the pricing is the deal is subject to adjustment due to the volume that's retained by the acquired firm.
Okay, great, thanks. I went ahead and closed that poll there. Over half of the folks on the call are experienced and currently looking. About a quarter have no experience but are actively looking, and then a pretty even split between the other two. Okay.
We're going to go in detail over the 7-step process that we use, and that really is a natural process for every deal. These are the 7 steps. So first, identifying target firms. The way to do that, one is to use networking, just basically developing relationships within the marketplace that you're trying to penetrate with relationships that you've created. Databases are, you can download public databases of all the accounting firms in your area. Certainly most larger 25 list or a top 50 list. But beyond that, it used to be in the old days, people would look at the yellow pages. I don't know how many firms actually are still in the yellow pages, and even if there is a yellow pages anymore. But downloading from public databases like Dun & Bradstreet or InfoUSA, those kind of databases will give you a list of firms in a certain market area. Working with consultants like us is a way to identify target firms. And what should you do in the initial contact? I think the important thing is to understand how you got into the conversation in the first place. So if you're cold calling somebody, you really don't know them. You don't want to go too far with what's the point of the call. I mean, obviously you want to talk about the potential for some kind of affiliation with them. But to say, gee, we're interested in buying firms, would you be interested in selling, is probably calling the question too quick. So some kind of planting the seed with an initial call. Gee, we know your firm is a well-respected firm in town. We're always looking to expand. Just kind of wanted to get to know you a little better, see if there's a possibility of us maybe doing something down the road. But just have kind of a lunch and a chat to get the door open. Now, of course, when you're working with us, we have already identified firms that we know are interested in an upstream merger or selling. And so the first conversation that you're going to have with those firms that we've introduced you to can get right to the issue because they've already been qualified and already developed to that level. Working with a consultant like us, but if you're doing this on your own, take into account just anything to do to get into the conversation is what you want to do. Be prepared to share this kind of information about your firm right up front. They certainly want to know how big you are, how many employees you've got, your partners, what services you offer, the industries that you're interested in, and your locations. That's minimum amount of information. that they should know about you before you really get too far along at all. The information you should try to get on them is this information. Obviously, their volume. You want to try to get a feel for what % of their client base is business clients versus certainly concentration of fees in major clients. I mean, if you're dealing with a firm that has 30% of their volume in one client, that's certainly an issue you need to know about. Something about their staff makeup, the partner makeup, and the issues on partners would be, you know, what kind of succession or career plans do each partner have? How long before people are retiring? You know, what portion of the firm do they own, and what role do they play in the firm? I get a feel for their billing rates, of pricing, but that way. And then details on their lease and the profit margin before owner comp. Now, for our clients, we gather this information in pretty good detail on every firm that we introduce them to. So going in, before you ever meet somebody, you'd know all of this, and you'd know whether this was a firm you wanted to meet based on the data that we've gathered for you on that particular firm. We're back into a polling question, Nikki. So.
Okay. This one is whether or not your firm has an owner agreement. So your options here are yes, and it's signed by all owners, yes, but it's not signed by everyone, no, but we need one, and no, we aren't sure we need one.
And of course, sole proprietors would probably answer no, we aren't sure we need one, but you will need one as soon as you add another owner, so maybe think about it from that standpoint.
And this is our third of 4 polling questions. We'll have just one more after this. Give everyone just a couple more seconds. Looks like a few folks haven't voted yet. Okay. I'll go ahead and close the poll, share the results there. 44% yes, and it's signed by everyone. 11% yes, but it's not signed by everyone. And then 39% are not sure they need one, with the remaining 6% saying they do.
Okay, very good. And if you want to learn more about owner agreements, we do offer webinars on that issue. You might look at the upcoming webinars and see what we've got available. Well, I know there's one in 2 weeks on admitting new partners, so that would be one that you might think about that I'll be doing. Introductory meetings. So what you want to make, again, you're looking at this from the standpoint of the buyer. What you want to make sure you do is share your business plan for the merger or acquisition. Why are you doing this? What are you trying to accomplish? And what role will this practice play in achieving your goals? It's important for that person to know that, because everything kind of needs to, at that point, be, you know, dealt with under that template of this is what we're trying to accomplish. The next thing, of course, is to find out what the seller's motivations might be and what their desired objectives are. So why are you interested in potentially selling or merging your firm up? What are you trying to accomplish with that? So that you make sure you're addressing that in terms of how you're, first off, deciding this is a firm you want to do something with, but secondly, how you might structure the deal. Find out as much as you can about them, but at the same time, remember you're selling yourself, you're selling your firm. It's amazing how often I talk to a seller after their first meeting with a client, and they basically say all this guy ever did was talk about how great his firm was, but he didn't ever listen to me. Didn't have anything to do with, didn't have anything to, wasn't interested in my firm at all and what role I might play in it. So keep in mind you're having a two-way conversation here. The other thing is that everybody has a choice here. So going in with the idea that I'm the only one that's going to make a decision here, I don't really care what your thoughts are, isn't going to work. So make sure that you understand that you really are in a selling mode, even if you're the one that's doing the buying. Getting in as soon as you can in the process, you should try to get some kind of deal on the table. Believe it or not, of course, we help accelerate the process with all the pre-development, before you ever meet somebody, all the development activity that we get involved in with the sellers. But it's generally the case that you should be able to get to an offer in most cases after 2 meetings. In our cases, we get to an offer after an initial meeting, but of course there's been a lot of pre-planning that's been done before the meeting. But there's no reason to go on. If you're going on to 3, 4, 5 meetings before you're ever talking about deal terms, you're really wasting your time. I don't know what you did in those first, those meetings after especially the third meeting. So if you're dealing with, for instance, a firm that has 5 or 6 partners, the chances are your first meeting may only be with 1 or 2 of them. And you do need to probably meet with the rest of them before you can go any further. But hopefully you can get the rest of those partners into a second meeting. And you can have the people from your firm at that meeting as well that they would need to know in order to make a decision. Yeah, this is something we'd be willing to do. And you can get to an offer after that. I'll tell you that firms that do a lot of acquisitions, the big firms, the big ones that you hear about regularly, they're doing acquisitions, get their offers out after 2 meetings. They know that time kills all deals, and the quicker you keep this thing moving, the better it's going to be. You'll have a chance to do due diligence. Keep in mind that all that information you got initially about their firm is a form of due diligence. The due diligence you need to do in terms of their work papers and contracts and employee files and all that stuff, that can be done after you actually know whether or not you've got a deal. So try to get to an offer as quick as you can. Make sure that the deal terms include these components. What the pricing is going to be. This is for an acquisition. What the pricing is going to be. How you're going to deal with retention. How you're going to treat new business. Are you going to include that in the purchase, or are you going to create a different kind of commission bonus plan for that? The tax treatment of the payments and the treatment of AR, WIP, and furniture and equipment. I would suggest, and we oftentimes, most of the time, don't use. When I say that, a letter of intent is a form of contract. It's something that needs to be signed by the parties. It invites the lawyers in. I hope there's no lawyers on the call, and if there are, I apologize if you misunderstand what I'm trying to say here. But it invites the lawyers in too early. As soon as the lawyers get involved, things bog down. It doesn't mean you don't need lawyers. You do need lawyers, but there's a time for them to get involved, and I don't think it's at this point in time. So we try to avoid formal letters of intent. At least get an informal kind of offer letter or term sheet, and then if you feel like you have to go to a letter of intent, do it after that. But get your deal agreed to first. If you're dealing with a merger, of course, you want to talk about the owner agreement and how that's going to impact the individual partners in the firm, defining what equity means and how you're going to determine in their case, how's compensation going to be determined for them. What capital contribution are they going to have to make? What's the business plan for the combined entity? Are they going to keep their office? Are they going to manage their office? Are you going to move people into their office? Talk about the general business plan and keep selling. Keep selling the upside opportunity. Due diligence. Why wait to perform due diligence? Basically what I just said. The reason why is because it's an invasive process. It's a deal. Why go in and worry about what their work papers look like if you're going to be in left field and they're in right field and on the terms? But we suggest strongly that you not get involved with the field due diligence, going through files, going through, doing technology assessments and all that until after you've got general terms agreed to. If you need to change the terms because of what you found in due diligence, do it. But it's so rare that we see that happening that it just doesn't make sense to bog down the process with due diligence. And some sellers are going to be unwilling to accommodate that. So they're just not willing to let you do that until they know whether this is a deal they'd really want to do. As far as agreements go, the biggest tip I can give you is don't use an agreement to negotiate the deal. What I mean by that is you've got a deal that's been agreed to. It's not unusual for somebody to say, we didn't talk about this, or maybe we need to deal with this a little bit different, or your lawyer's giving you some input. Rather than just sending someone a new contract that has a red line to say, oh, we changed this to that, unless it's a very minor issue, call the person and talk to them about it. Tell them why you're having to make this change, why you need to reopen the conversation about that term. Don't let them find out because they discovered it in a red line to the contract. But I see that done way too often. This is where deals can actually blow up because people start getting mad at each other. They feel like they've been not dealt with fairly, like somebody's trying to sneak something by them. And I know that's not generally the case, but it feels that way. So make sure that you talk to them about any changes that you're going to make that you have to make in your contract before you send it to them. Transition, what defines a good merger or acquisition? Well, the first thing I'll tell you is retention, retention, retention. If you don't retain clients, you don't retain employees, it's difficult to have a deal be successful. So what that means is, as you're introducing changes to the practice that you're acquiring, keep in mind how that's going to be received by the clients and by the staff. It doesn't mean you shouldn't make the changes, but it may affect when you make the changes. The more you change up front, the harder it is for people to be enthusiastic about what's going on. Trying to create as much continuity as you can. There's two different kinds of changes that you're going to make. One is what we call behind the door, and the other is in front of the door. The stuff that is in front of the door is what the clients are experiencing. So anything that you do that changes the client experience with that firm is something that they have to ask themselves, is that something I'm okay with? So if they've been used to getting billed once a year, and all of a sudden you're billing once a month, that's a behind, in front of the door change. Obviously, if you're changing the people that they're dealing with, that's an in front of the door change. If their fees are going to go up significantly for the same services they've been provided, that's an in front of the door change. The more those things are happening, and the quicker they're happening, the harder it is for the client to accept the deal. The behind the door changes are the things that primarily affect the people in the firm, the partners and staff. Those things are probably not as critical. It can be annoying. There can be too much to deal with at one time. But for the most part, those generally are not going to cause retention problems. So it doesn't make sense, for instance, to change somebody's tax preparation software on January 31st. But most of the behind the door changes are not going to be as much of an issue affecting retention. The communication, the 5 questions every client asks are basically, what's this mean for me? And that comes down to, can you still provide the same services that you provided in the past? Who's going to provide those services? Is it going to cost me any more than it has in the past? Is it going to be as convenient for me? And the way you deliver your service, is that going to change? And the 5th question, remember, you're dealing with the person that you're talking to is the seller, typically. What's this mean for you? Is this a good deal for you? If the person making the communication with the client can answer each of those in an affirmative fashion, your retention shouldn't be an issue. So anytime you communicate with those clients about what's happened, keep in mind those questions in the back of your mind. You want to make sure you're answering those questions as you're communicating with the client. And who to actually send with the message. I think it's a good idea to not let the seller go by themselves unless it's a merger. If it's an actual sale, their successor, unless there's going to be a long period of time before a successor actually steps in, say the seller is going to be with you for 4 or 5 years. Once the successor needs to be introduced to the seller, the successor needs to be in that meeting. So it's oftentimes a 2-person meeting. I think this is our last polling question.
It is the 4th and final polling questions on the screen. What issues do you see affecting your practice most in the next year? Is it succession for retiring partners, admitting new partners, client retention for retiring partners, or a need for growth? We'll give everyone just a few more seconds. All right, I'll go ahead and close the poll. Results are there on the screen. 3/4 of the folks say need for growth, and then 21% indicated succession for retiring.
Okay, that's what I would have expected for this presentation. Okay, so I keep bringing up this 2-stage deal, and we're going to talk about what a 2-stage deal is. A 2-stage deal generally works when you've got somebody who is 5 or fewer years, usually 2 to 5 years away from, let's say 1 to 5 years away from wanting to slow down substantially or retire altogether. This is on the seller side. So what we basically are doing in stage 1 is we're kind of keeping, it looks like a merger, it's treated like a merger in terms of operationally, but it's still a sale. The sale occurs on day 1 of stage 1. So the day that you close, you sign the contracts, you effectively, if the seller has sold the practice to the buyer. So the seller merges into the buyer's firm. Sometimes they move their offices in, sometimes they keep their office. thing is they're starting the transition process, so that they're starting the process of turning over their relationships to the buyer. Now, obviously, if they're only going to be around for 2 years, you're going to be doing that up front than if they're going to be around for 5 years. The longer you give it, the more involved the seller is in the process, the stronger the transition is going to occur. That's what's so powerful about this technique. You give the seller reasonable control over the clients during this transition period. As they reach the end of stage 1, they should be basically ceding control to their successor. They usually take on a principals or non-equity partner role in the firm, although I wouldn't call them that externally. I try to call them, a partner if you can. And normally they're going to maintain their compensation level. And the way they do that is typically we tie their compensation to volume. So if they've been making 35% of the volume, we basically tie their ongoing compensation to 35% of their ongoing volume that they maintain at the firm. That's the simplest way to do it. So during that stage 1, they maintain their volume. They keep working full time. If they cut back, we have means of adjusting the compensation. And as long as their volume stays intact, they basically keep making what they've been making. Stage 2 is when we start paying for the practice, and that happens when they quit working full time, and we oftentimes define that as something less than 60% of full time. If they keep working for you, typically they'll go into a per diem role where they might get paid a percentage of their billing rate. This is when the payments start, and the payments are oftentimes look just like they would in an immediate sale. So for instance, it's not unusual to see a 2-stage deal where 20% of collections for the 5 years following the commencement of stage 2 is how. Now, what we've done is we've taken out of the risk factors for both firms the risk of retention, because the clients have already assimilated into the merged firm. So the only issue you've got left is, if the client base can stay intact for natural reasons typically. So it's a much more powerful, it creates a much better transition. Everybody comes out ahead because of it. And that's a technique that we use oftentimes with the deals we're involved in that are, times we'll use a 2-stage deal and a merger for the client, the partners that are going to be leaving in the next 2 or 3 years, and maybe a merger for everybody else. The 4 C's. These are the most important issues in terms of how to assess whether or not 2 firms are a fit for each other. Chemistry, which comes down to how well we get along. Do you like the people that you're talking with? If you're talking to somebody and you can't imagine having lunch with them on a regular basis, you probably shouldn't do a deal with them, because in the long run, they're not going to. It's not going to be a fit. Capacity, making sure that you have the capacity to replace anybody that's going to be leaving. So if you've got a sole proprietor with $1.5 million practice, making sure you've got capacity to take over for that person or going to be able to build that capacity. Continuity, which we talked about, the more you can maintain things as they are, the better the retention, the better the success of the deal. And then a culture. And of course, everybody talks about culture being important in the fit of firms, but very few people know what that really means. I mean, you sort of have a gut feel for what culture is. The way I define culture is to ask yourself 3 questions. What's it like to be a partner in this firm? In other words, what kind of accountability do we have? What sort of role do partners play? How's the firm, what's a partner's role in client service? What kind of partner charge hours are expected? What kind of practice development expectations are there? Those kinds of things. What's the partner agreement look like? What's it like to be an employee in this firm? Some of the same issues, what kind of expectations are going to be are you going to have of an employee? What kind of benefits? What's it like to be a client in this firm? If you can answer those questions, that's generally what defines culture in most firms, and that's how you can assess whether or not 2 firms are a fit. So, for instance, if being a client in one firm means that you're going to be served primarily, by email and virtually, and you're not going to very often see anybody, that may not be a good fit with a firm that's used to having a lot of face-to-face contact with their clients, as an example. Some articles I'd recommend for follow-up. We did a series on succession issues. It was 12 consecutive articles in the Journal of Accountancy from July 2013 to 2014 that address all different issues related to succession and mergers and acquisitions. And you can download those from our website. We did a second series later in 2014 addressing valuations for small firms, large firms, and internal. And then last December, Journal of Accountancy published one of our articles on how to admit new partners using the AAV approach versus a compensation-based approach to owner agreements, and I'd recommend that as another article. Also recommend using the AICPA Succession Planning Resource Center, which this picture down here is Joel Sinkin, my partner, who we provided quite a bit of the content on the center, not all of it. Bill Reeb of Succession Institute was also involved in this, as well as some other people. So it's a very powerful resource. Finally, I'm a member of the CPA Consultants Alliance, which is made up of these different consultants in these different areas, all nationally known. And we have done, we wrote a book that you can buy on Amazon, which I highly recommend, Bridging the Gap, which talks about the issue of emerging leaders in the CPA profession. And we have also published several white papers on that are database that talk about different issues that most CPA firms are addressing. With that, I appreciate your attention today and your attendance, and I'll turn it back to Nikki to wrap up.
Great. Thanks so much, Terry. I will end the webinar shortly. Please don't forget to leave your browser open. The survey will pop up immediately afterwards, and you'll just complete that, and then you will hear from me with your CPE certificate within 2 weeks. If you have any questions for me about the CPE certificates or would like a copy of the slides, just send me an email at that address there. You'll also receive a follow-up email in about an hour that will include links to all of those articles that Terry referenced. So we thank you again for attending, and we hope that you enjoyed the webinar. Thanks so much.